Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today, we're diving into a report that might sound like financial alphabet soup, but trust me, there are some interesting twists. It's all about bonds, debts, and a federal home loan bank. Don't worry if that sounds boring now, we'll see what it all actually means and if there's anything to worry about. We are looking at what's called an 8K filing from the Federal Home Loan Bank of Indianapolis, or FHLBI for short. It's a snapshot of significant events that investors should know about. This report is dated early March of 2025, so it's fairly recent. The juiciest part of this report is about the bank creating financial obligations, essentially taking on debt. They are doing this through something called consolidated obligation bonds. Now, these aren't just any bonds. They're issued by a bunch of federal home loan banks together, making them jointly responsible for the debt. Think of it like a group of friends co-signing a loan. If one can't pay, the others have to cover. Let's break down some of the bond details because that's where the story lies. This table gives us a bunch of details about bonds the bank is dealing with in early March of 2025. We see different settlement dates, which is when the bond transaction is finalized, stretching from mid to late March of 2025. The bank is issuing a lot of debt in this period. Then we have maturity dates, which is when the bonds need to be paid back, going all the way out to 2055. That's a long time. A lot can happen in 30 years, so they will definitely have to consider that. The coupon percentages or interest rates on these bonds are around 4 to almost 6%. It shows what rate the bank needs to pay its lenders. The bank is dealing with millions of dollars here. They're issuing many bonds with par values ranging from $10 million all the way up to $85 million for a single bond. That's a lot of money changing hands. It shows how much capital the bank is moving around. Then there's different call types, which means the bank has the option to pay off the bond early. The question is, should the bank pay off the bond early or not? You can see different styles for how the bank is able to pay it off. You can see bonds that are American, Bermudan, and European. These names don't mean anything about where the bonds are from. Instead, they relate to when the bank can redeem or pay back the debt. American-style bonds can be redeemed at any time after a certain date, like an open option. Bermudan-style can be redeemed only on specific dates, giving the bank less flexibility. European bonds are the most restrictive. They can be redeemed only on one specific date. Most of these bonds are fixed constant, meaning the interest rate stays the same over the life of the bond. This makes planning easier. Here's the catch: these consolidated obligations are not guaranteed by the US government. This means that in a crisis, these bonds don't have the full backing of the government. It is also important to remember that since these are consolidated obligations, they are the joint responsibility of the FHL banks. This also means that they're not keeping track of every single bond. Keep in mind that we are also not seeing everything. The report only contains some details. Also keep in mind that the numbers here are not the full picture, as there can be discounts or premiums on the bonds. So what's the big picture here? On the one hand, issuing bonds is a normal part of how banks operate. It's a way to raise capital, which can then be used to fund loans and investments. The FHLBI is using this money to support its member banks, which in turn support local communities with mortgages and other lending. However, taking on debt always comes with risks. The bank needs to be sure it can generate enough revenue to cover those interest payments and eventually pay back the principal. The fact that these bonds are not guaranteed by the government adds another layer of risk, even though the FHL banks are all responsible. The report is signed off by Lana D. Butchman, Associate Director of Financial Reporting, which indicates that the bank stands behind these figures and statements. All of this is done in compliance with the Securities Exchange Act, meaning they're legally obligated to tell investors about these financial moves. This creates trust between the bank, investors, and the government. Looking at this report overall, the FHLBI seems to be playing a balancing act. It's leveraging debt to support its operations and member banks, but it's also taking on significant obligations that aren't government-backed. For the average person, this might not seem like a huge deal, but it's worth keeping an eye on the bank's performance and how it manages its debt. High interest rates could be a risk, although the bank is counting on having predictable constant rates. Overall, I would say that the report is risky. The company relies on other banks for reliability, which is hard to estimate and is vulnerable to any fluctuation in rates and other economic changes. Thanks for watching. If you enjoyed, please subscribe, like, and comment.